Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. This last part, Mr. Valuation, is very critical to the video that I'm presenting today. I'm going to cover DocuSign. It's a very hot stock, about 2 or 3 years old as a public company, and it's tripled, I believe, initially for the last couple of years. And then all of a sudden they had a major drop in the stock price on Friday. And I'm going to go over that and talk about it, but the key is what this really does is represent a classic example of what I consider to be, and I've often called those of you who followed my work, dangerous overvaluation. Overvaluation becomes dangerous when it becomes far separated from the intrinsic value of the business. Now, sometimes dangerous overvaluation can lead to a dreaded flattening of stock prices, sometimes for years. We saw that years ago with names like Walmart, Medtronic, etc. But sometimes you can just have this immediate reduction in value and market cap that gives you absolutely no opportunity to protect yourself. And that's why valuation is so dangerous. So let's go ahead and let's look into the company itself. This is DocuSign, and they're the company that basically allows you to share signatures and to sign documents electronically. All right, now looking at the fast graphs without stock price, I want you to note some things. And I also want to interject here for those of you who are subscribers, the way to utilize this tool. You have to always remember that fast graphs is dynamic and that it's data driven. So what we have here is in fiscal years in January, and for 2019, the company's earnings grew to 9%, and it was 123% growth. For fiscal year 2020, which ended again in January of 2020, earnings growth was 244%. Earnings went to 31 cents. And then in 2021, they went to 90 cents, and that was 190%. And then 120% growth in 2022 expected. But then that growth is expected to slow down, okay? Now, when you're looking at this, you got to understand that we're using a P ratio equal to the growth rate. So here, because we have no calculation, we had negative earnings this first year, not really shown on the graph, we don't really calculate a growth rate. So I'm going to take a year off of this graph, all right? And now I've got 244% growth for fiscal year 2020. I've got 190% for 2021. Remember, this number here is an average of these numbers, okay? But if you're using this tool correctly, the first thing you should recognize is growth went from 244%, which is incredible, to 190%, which is still incredible, to 120%, which is even still very incredible, but then expected for fiscal 2023, which ends in January, obviously, only expected 11% growth and then 26% growth going forward. Okay, note that I have no price on the graph, but I want you to understand what you're looking at. Because of this absolutely astronomical growth rate, we're using the PE equals growth rate formula that Peter Lynch, P equals growth formula that Peter Lynch made famous. So this orange line is being drawn at a PE ratio of 98, which is 5 or 6 times higher than the average company trades at. I want to make that clear. But now there's some arguments that this is justified, okay? But here's the point. Even at that PE ratio, if I bring price back into the equation here, I want you to see that now all of a sudden the stock looked extremely overvalued, even at this 98 PE ratio prior to Friday's drop where the stock fell from somewhere around in the 240s down to 135, which is what it closed at on Friday. Okay, that's over a 40% drop in value. This happened instantaneously, no protection whatsoever as an investor. Now also watch what happens as I shorten the time frame here. This is a dynamic tool that you can access this dynamic data so easily. Subscribers use it. Notice the growth rate is now slowing down to 70%. Now it doesn't look undervalued at this point. It still looks overvalued. If I drop it to 3 years, this will be the last year I can drop it. The growth rate is down to 40%. But here's where it even gets trickier, okay? If I go into the forecasting calculator, all right, I've been looking at the historical graph. If I go into the forecasting calculator, earnings growth is expected to be 22.14% going forward. Okay, and that includes 120% this year, but then 10% and 25%. So growth is expected to slow down. The long-term growth rate is expected to be 50%, okay? And so we're putting a maximum PE of 30 on that, but you could put even a 45 or 50 PE if you felt confident that the stock would trade at that. But even at that level, even if I put a 45 or 50 PE, then you've got a 26.87%. Now, by the way, this gave me an opportunity to share. I had a question on the new version of Fast Graphs, which we just launched yesterday. If you go out to these far side, these pop-ups will pop up to where they hide behind the thing. All you got to do is grab them and drag them, and you'll be able to see them. That's just a little tip on using the graph. Okay, but the bottom line here is DocuSign was extremely overvalued, even with crazy valuations applied to the stock. That's the part I think that's most important. We still had this significant overvaluation, but yet from April of 2020, let's say, when the PE ratio was astronomical, really, all the way through yesterday's close, this stock increased it tripled. It went from 10,000 to 33,000 in this 2-year period of time. And the rate of return was 109% per annum. If I measure that adjusted after yesterday's close, the rate of return is still 38%. Okay, so I do want to make it clear, but anyone who bought this stock when it got really separated, anyone who bought this stock at a price obviously even over $139 a share, all of a sudden now sees a negative rate of return. Valuations like this are very, very dangerous, and they can drop virtually without warning, okay? Now, I do want to give you some perspectives on that. So what I'm going to do here is I'm going to look at a couple other companies here that were overvalued, not to the extent that DocuSign was, but I do want you to see a stock like Medtronic. What I want you to understand is Medtronic was coming into the recession of 2001, was trading at ridiculous PEs in the 40s, and it was significantly overvalued. And notice that the stock price pretty much went, I'm going to call it, here's where I can drag, was $46 a share. It's still in the 40s, got up into the 50s, got down into the low 40s again. Obviously we went 5 or 6 years here of negative performance. In fact, if you bought and held it even to fair value, your rate of return was 0.4% over a 5 or 6 year period. So valuation can be very, very dangerous, and this was the dead of drip. But the difference here is, with a name like Medtronic, once you recognize that the stock was overvalued, you were given literally years where you could have got out of the stock. With DocuSign, once the market recognized this stock was overvalued, the price collapsed. Now, I want to take a look at a couple other metrics here. I want to look at things like diluted earnings, and that's important because this company is actually showing negative GAAP earnings, which gives you an indication that there's a lot going on with the company. Operating cash flow has been strong and growing at a rate of about 50%. But when you see numbers like this, what I'm really encouraging you to do is make sure you dissect those numbers. Go in here and look at what comprises those numbers. And obviously you had this huge growth in cash flow in 2021 and expected to be very strong again in 2022. But once again, it did not justify these high valuations. And what's really funny about this, if you go to the Wall Street Journal article, it was actually an article in MarketWatch that talked about why, the headline was, electronic signature company drops more than 40%, shredding nearly $20 billion of market cap as the pandemic boom in these signature sales slows down. But let me put that into perspective. This company's billings growth was 28%. Now, it was less than the estimated 34% guidance that the company gave for the third quarter, okay? And part of that was pandemic induced, where the company was getting some really good opportunities based on the pandemic. But that in itself wouldn't justify a 42% drop in value unless the company was significantly overvalued. And there are a lot of stocks in technology and a lot of hot stocks out there that look like DocuSign right now. I want to make that clear. And I wanted wanted you to see the opportunities that exist here. There are some real positives of this company. For example, its sales growth has been over 30% a year. All right, now its price to sales has been about 18 times sales, and it's actually trading right now at about 13 times sales. And sales growth is forecast to continue growing in excess of 25%. Long term, it's expected to grow at 50%. Okay, so, you've got a company that still has tremendous growth potential. And based on earnings, I believe the stock still looks overvalued. I want to make that clear. because I don't think earnings growth can support this kind of valuation. We still are looking at a PE of over 75, an earnings yield of only 1.3%. And keep in mind, this is a growth stock with no dividend. Okay, it's currently got a market cap of 26 billion, but if they lost 20 billion, it had to be 46 billion on Friday before they lost it. But you would have lost 40% of your money had you been a recent buyer of this company, even or more if you'd have bought it at its peak valuations when the stock price really got up here like above $300 a share. So be aware of overvaluation. It can come without warning and it can hit you hard and fast like it did here with DocuSign. This is actually a pretty interesting company, and maybe if it does continue to grow in sales, maybe you would want to start building a position now at these low valuations. Kind of interesting. I did read one comment in the Wall Street Journal that talked about Kathy Wood. I guess her firm bought a bunch of it, okay? But her ARC is also down significantly because of that. And companies like Adobe, Adobe dropped also. But I also want to point something else out to you. When you're reading these kind of headlines, you've got to beware of the hype that's associated with them. Okay, Adobe dropped, and you can see the drop here. If I go into the forecasting graph, it's easier to see, but this is a 10% drop. Okay, it doesn't look that, it's certainly nothing like what we saw with DocuSign. But if I go to the Wall Street Journal article, Adobe is worth $26 billion less as DocuSign fears spark knee-jerk reaction, okay? But this is a $290 billion company. So if it's worth, if you go back to the headline, if Adobe's worth $26 billion less, that's less than 10% actually, because it still has a $29 billion market cap. So that's almost within the normal volatility this stock has been trading at over the years. But beware of valuations like this, because at some point, if sentiment turns and changes, then these companies will come back to these valuations that have been historically normal and historically precedented. Anyway, this is Chuck Carnevale, aka Mr. Valuation, just pointing out the risks of owning very high valued stocks. And there's a lot of those in the marketplace today. I just want this to be a lesson to you to understand that high valuation can be disastrous, and it can happen in an instant, and it can happen without warning. And keep in mind, DocuSign did not collapse from a standpoint of the business. Their growth was 28%. The average company grows at 6 to 8. Their growth was 28%. Let me repeat that. But it was expected to be 34%, and that was enough to change sentiment to cause an absolute swift and brutal, if you want, downdraft in the stock. Be careful with overvalued stocks. If you own them, sometimes it's prudent. If you don't want to sell them all, at least take some of the money off the table, maybe your original cost basis, if you've doubled or tripled your money in some of these high flyers today. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. If you did, give me a like. Ring the bell if you want to be notified for future videos like this. We'll have a lot more coming. We really appreciate y'all. If you haven't subscribed to the channel, subscribe. And by the way, you might want to test drive this new version of Fast Graphs. We launched it yesterday. There were a few bugs. Not really many. I'm actually very happy with how it was launched, and we're going to be doing a lot of tutorial videos on how to use this tool, and I tried to interject a little bit of that here with this DocuSign video. Anyway, it's been Chuck Carnevale saying thanks for watching. We appreciate y'all, and we'll talk to you again real soon.